Investors Chronicle.
Hello and welcome to Lee and the IC, the podcast in which we look at the UK stock market and beyond through the eyes of one very experienced investor. I'm Alex Newman, an associate editor at the Investors Chronicle, and that investor I just mentioned, as regular listeners of course know, is John Lee, Lord Lee of Trafford, who I'm sitting with here in the FT studios as we record on Monday the 3rd of November. John, how are things?
Fine, thank you. Fine.
A good half term?
A very good, a very pleasant half term, a nice break with the grandchildren in the New Forest. And we're on the back of quite a successful period on the stock market from my point of view.
Brilliant. Lots to unpack there. There's no proper chronology to the episodes of this podcast, but for those of you who listen regularly, you may know that last time we spoke, we interviewed M&G Chief Executive Andrea Rossi. That was obviously very heavy on the M&G content, appropriately enough though, given that the group is your biggest holding, John. But we were a bit light on portfolio updates and wider musings. So today we're going to return to that theme and focus on both. Before we crack on, I'm going to give the familiar reminder that nothing we say or talk about on this podcast should be taken as financial advice or a recommendation to buy or sell shares. And as ever, we recommend you do your own research. John, we'll come to the latest happenings in the portfolio in a second. At first, I thought I'd ask for your reflections on that conversation with Mr. Rossi, now that he's not here in the room with us. Mm-hmm. He projected a lot of confidence, but CEOs are often very good at doing that. Did it change or reaffirm your views on the company?
I think it definitely reaffirmed my belief and faith. I think overall, yes, he was pretty optimistic. I think I asked him the question at the end, one that I put to chief executives on an optimism scale of 1 to 10. Where are you? And I think he was well up.
9, wasn't he?
He was certainly 9. And the interesting thing to me also was that he mentioned dividend growth on a number of occasions. And I think people had assumed that the dividend from M&G was at a peak, and therefore people were buying, hopefully a maintained 10% dividend yield when they were originally buying, some months ago when they were yielding 10%. But it was interesting that he was talking or implying that, he was looking forward to dividend increases, which I thought was a plus. So overall, I've been very pleased with M&G's performance. I've always thought they should be on a yield of about 6.5%, broad brush. When I started to buy and started to talk about them, I think they were yielding about 10%. Well, they've obviously risen, particularly with the Japanese coming aboard. But the yield is still now 7.5%. So, hopefully there's some way to go, and it'd be nice to see a dividend increase at some stage.
On the kind of operational side, I mean, we did have a follow-up question from a reader who sounds like they've been watching on with slight incredulity or perhaps regret, noticing that a lot of the asset management sector has struggled quite a lot, and yet
as a sector,
whereas M&G seems to be ploughing ahead. They asked, is the key differentiator that life insurance exposure?
I think that is in part, but I think also Andrea Rossi made the point that a majority of their funds under management now are from overseas. And I think that is probably something that has benefited them, particularly the overseas content.
Well, as you said, a very successful couple of months for the portfolio. But I wanted to start with specialist ingredients manufacturer Treatt, which has...
Thought you might.
So just to recap very briefly, this was once your largest holding, I think. We then had a multi-year slump. And 2 months ago, we had what looked like the beginning of the end with this 260p a share bid from Natara Global. We touched very briefly on it last time we spoke, but I think you commented at the time, or for an article we wrote, that you'd be surprised if no alternative bid arrived, and so it proved. Can you bring us up to speed, John, and where you are with Treatt?
Yes. So Natara bid and projected that they would do it under a scheme of arrangement, obviously designed, I think, to save the bidder money and maybe to improve the timescale as well. But then what we've seen is the German company, big private German company called Dola, coming in and buying mopping up Treatt shares, started to buy themselves, and then they did a deal at 305p, I think I'm right in saying, with Coastal and American Arb, and that took them up to 20%. And they've since built up to 25%. They seem to be sitting there, but that effectively gives them control of the situation and the company, because they can block the scheme of arrangement, and almost certainly will, and effectively control indirectly Treatt. And I'm sure we'll want board representation and management changes. And I think their plan, so far as one can tell, would be to rebuild Treatt. But of course, the interesting thing here is this really proves the vulnerability, and I think probably for the first time, of a scheme of arrangement rather than going down a traditional takeover route. And by Dola coming in, they've effectively killed the Natara bid. Now, we don't know what is going to happen. I'm sure there are talks taking place or have taken place. I have no direct knowledge, but I suspect, between Natara and Dola, whether any deal can be done, I don't know. But of course, we then saw a gradual decline in the Treatt price from the 290p improved bid, and the shares drifted down, and it became quite clear that there was a significant risk that if the bid totally collapsed and Dola didn't continue to mop up, then the Treatt price could slump to around 200p or below. So it was really a difficult decision from an investor like myself, because obviously I didn't want to lose that 50p if things had went wrong. On the other hand, if some deal is agreed or someone else appears, you never know, there could be upside. But being a fairly conservative investor, and also having a fairly large, for me, holding in Treatt, I decided that I would, adopt the cautious conservative approach and sell my holding. And of course, I also had to make sure that I was selling when Dola was still buying, right? Because in normal market terms, I wouldn't have been able to dispose of my holdings. So I sold out, I think, at about 245, something like that. Over the years, I have done very well, because I think originally I was in at about 33p when I started to buy in 1999, the equivalent of 33p. And then 3 or 4 years ago, when the Treatt price was well up, I did sell 20% of my holding as the price was rising. So between, I think, £4 and £10.86, which was the peak. But of course, when the shares went to £12, my holding was worth quite a lot of money, and sadly, we've seen it come all the way back. So there we are. Overall, Treatt, from my point of view, successful investment. Could have been much more successful had I got out anywhere near the top. But I think one of the big lessons is for those investment bankers and similar who are advising on takeover strategy, advising companies, they've got to be very, very careful on schemes of arrangement now, because they can be really, really fouled up by other companies coming in and buying in the market.
Yeah, it seems almost naive in retrospect, doesn't it, that they didn't spot this potential snookering of their.
I don't think.
position. Yes,
I'm not aware that it's ever really happened before.
Right, okay.
Normally the scheme of arrangements go through. I'm not aware of one that's, as you say, have been sort of snookered by someone coming in to buy.
Yeah. Okay. Well, a bitter sweet end to that saga, I suppose.
I think that would, you could say that, yes.
Appropriate enough for a specialty ingredients maker. Let's move from disappointment to triumph then. Last time we touched on Goodwin, they just had their July results, I think, which pushed the shares up to around £100 from less than £80 at the start of this year. That all now feels like an age away, because we've had 2 huge trading updates since, which for a company which is quite tight-lipped on what it's up to is a real sort of real turnaround. The shares are now just off £240 this morning. And outside of gold mines, I think it makes Goodwin the best performer in the FTSE 350. And what's been going on, John?
I think it was one of the Rothschilds who in the past said there are three ways of losing money: wine, women, and engineering.
Okay.
The first two are the most enjoyable, but the third, engineering, is the most certain.
Right.
But all I would say is that Goodwin has certainly proved Rothschild wrong.
Okay.
It has been an outstanding success story, and of course, Goodwin's really has been under the radar as far as most investors been concerned for a long time, have controlled by the family, not employing any PR firm at all, being pretty conservative. But those who got in early years have really done amazingly well, and I was rather late coming on board. But nevertheless, I've probably been on board 4 or 5 years and have seen incredible growth in the value of my holding, and it's now one of my big 3 holdings. I visited probably 2 to 3 years ago and was hugely impressed with the family members that I talked to. What was very rare or what is very rare, is that normally in a family-controlled PLC, from my experience, you've got one member of the family who's really sort of keen and runs the business, and maybe a couple on the board who aren't so active and aren't so focused on the business. What I found with Goodwin's, and others have found this, is that the 4, maybe even 5 members of the current generation, cousins and similar, I think they're the 6th generation of the business, are all absolutely focused on growing the business and motivated and obviously incentivized because of the holdings that the family have got. And the amazing thing to me is the range of activities that the Goodwins have, the range of product areas. And I know people who do know engineering businesses are surprised at how they do manage to have the range. But at the present time, pretty well all divisions are actually pointing substantially upwards. Hence the trading statement last week that indicated that profits were going to be 100% up. And this is from a conservative company. When you get the annual report from Goodwin's, it's almost like something on a Caxton printing press. They're the opposite of sort of slick PR in all senses. So the fact that they said profits are going to be 100% up, probably there'll be even more than that. But of course, the shares have responded with a substantial bounce, and the PE on last year's profits is probably around the 70 mark. Well, of course, doubling of profits as the forecast brings that down to probably just over the 30 mark. But of course, none of this includes the potential of this new high performance polymer, Develco, which they have developed, which they are excited about and they believe has global implication. And the reports coming out are very, very encouraging. So it remains to be seen, but I think it's got a long way to go. I think I've said on this podcast before that I think it's probably one of our most exciting engineering companies, probably outside Rolls Royce, and so far it has delivered.
Yeah, and kind of emerging from under the radar a little bit, it seems.
Absolutely, yeah. And of course, quite amusing that one of their divisions actually does produce a lightweight radar as well.
Indeed, yeah. In terms of the valuation, I tried a few weeks ago because we were talking about the company on our other podcast, and I think at the time that they were trading at a valuation of around £1 billion. It looked like pre-tax profits of 50 million were feasible, and so 20 times earnings was about fair. But that's obviously now been left in the dust. That as a real underestimate, and they're saying trading profit, I think, likely well above 71 million. So if it's 75 million, say conservatively, that means the shares are still only on 23 times forward earnings. And like you said, that we're not, they're not really talking about the thing they're really excited about. That's not even factored in. So are you kind of comfortable with the valuation given the momentum?
Well, yes. Would I want to be buying at these levels? I'm not sure.
Okay.
But certainly, for my holding and the vast majority of it anyway, I'm very much staying aboard for the long term. And generally speaking, it really pays, I think, if you're in a really good company, not to be too clever and take too substantial profits. I'm not against, taking the head off a very large holding, as it were, and maybe trying to get in to rebuy lower down.
Got you.
But fundamentally, I'm very much a long-term holder, and I believe, to put rather crudely, that in investment terms, there's an old American adage which says, you make your money by sitting on your ass. In other words, get into something and stay with it. Those who hop in and out, I don't believe actually ever make any substantial money.
Yeah, and with the thing we didn't even talk about in this is the I suppose it's underlined your income focused approach to investing, because they announced this special dividend. I think it was 500 odd pence, wasn't it? But
yes, to be paid, I think, within the next couple of weeks. Before the budget.
Yeah,
yes.
And we will come on to the budget later. I thought it was interesting in that they characterised that as surplus funds exceeding those needed for optimal efficiency, which is kind of rather engineering way of putting it. Reading between the lines, did you get any sense of what that might mean, or it's just that they're doing so well at the moment that they don't want cash?
Well, I think they're doing so well. I think on certain of the big defence contracts, I think they probably get money initially, as it were. I think they have received financial support in particular areas from the American government Department of Defense, because they're crucial to the American submarine program, and perhaps from MOD as well. But, they've handled their cash very conservatively over the years. And, with all divisions really pushing forward strongly, it's not surprising that there's been a dramatic improvement in the cash position to enable them to increase the normal dividend, which I think is almost certain, and give us this special dividend as well. I'm personally not over keen on special dividends, really, because I don't think they're ever fully reflected in the price.
Right. I
much prefer to see a special dividend merged into an increased annual dividend. But nevertheless, it's obviously nice to have, and it gives one the liquidity to make other investments as well.
Yeah, and without blowing their trumpet too much, I suppose you can hardly fault their reinvestment in the business and finding new ideas for ways to make money. So maybe it's a sort of victory lap of sorts. I noted from your register of interest in the House of Lords, John, that you sold STV, the Glasgow Media Group, at the end of September. We've not really talked about that company much. I mean, it's like Treatt, it's had a rough few years. I think in July they issued quite a chunky profits warning. There's sort of deteriorating conditions, I think, which we've talked about here before, around advertising and commissioning for a studio. You've clearly decided not to hang around for a potential recovery. What was your thinking there?
It was a small holding. I didn't really know it well.
Okay.
I bought it somewhat speculatively. I think the view was that probably at some stage ITV would probably pick it up.
Okay.
And buy it, because they have a very close trading relationship with ITV, but that hasn't transpired. There's been a change of management there as well. A small holding, and I was making a loss on it, and I decided to kick it into touch. Possibly I should have sold it somewhat earlier and maybe applied a stop loss, but I didn't. But generally speaking, I'm not in favour of keeping loss makers in a portfolio, because they actually knock one's confidence a little. So my general advice to fellow investors is, if something is showing you a loss and you're not really confident that it's going to recover, then take the loss on the chin, sell it and move on, because otherwise every time you look at your portfolio and you see the loss maker there, it pricks and draws blood. So move it along.
Interesting. On the other side of the ledger, you've a couple of new holdings. One is Venture Life, a company I'd not heard about, and a relative minnow at £70 million market cap. What does this company do, and what's the investment case?
Well, Venture Life was drawn to my attention. Slaters, who are an investment house that I know well, own I think 29% of it, which obviously is a very encouraging sign, and they believe in it. Venture Life essentially, well, they originally manufactured and distributed, now only distribute a range of male and female health products in very broad terms, and sell through virtually all the supermarkets and the Holland and Barrett's and the chemists and Boots and what have you, and they sell their manufacturing interests. And so I think now, you mentioned the capitalization of about 70 million. Half of that now is in cash.
All right.
And I'm pretty sure, having talked with and met their chief executive, that they will be looking to use that to buy more brands.
Got you. Okay.
And they also brought on board a couple of very experienced and senior women who know the sector well, and I take an optimistic view of the way forward. I mean, the only debit is they're not a dividend paying stock. I hope that they move to a small dividend before too long. But I think they're experienced. I think they know what they're doing, and I think this concept of adding brands to a distributing company actually can be very successful. And we saw this years ago. There was a company in the Northwest that I invested in and did well called Seaton, Seton, who started in tubular bandage, and they bought up a range of other brands, and two made at least 5, and in the end the whole group grew and was sold to a much larger. And I suspect that probably that will happen, all being well, down the track with Venture Life. So I think it's got a good few years to go as an independent company. I've made it quite a useful holding in my portfolio. We shall see.
Okay. Another, I think I'm right in saying, relatively recent new stake is James Halstead, or is that that's the commercial flooring group? I mean, they've been around forever. So
they've been around for a long time. I used to be on the board years ago, so I know it. I know it well. They've had a very, very good track record until the last 2 or 3 years, when their results have been on a little bit of a plateau. But it's a very solid global business in floor coverings with relatively cheap cost of production, and a lot of cash. They've always been very conservative and pretty well increased the dividend year on year. And they were quite highly valued. As a result of profits being on a plateau, the shares have drifted back, but the yield is now about 6%, and the P ratio quite modest. So I think they're an ideal stock to put away in one's ISA, with a very nice certain dividend yield, and I think prospects of upward revaluation.
Yeah, I'm just looking at their balance sheet. It's interesting to compare it, I suppose, to Venture Life, although they're obviously in self-care and flooring, quite distinct markets, but they own their manufacturing base, don't they? So they've not only got the cash, but the factories as well on their balance sheet. I suppose from a branding perspective, it might be harder to pitch flooring as sort of branded products, but
yes.
But at the same time, that's more security in a different kind of business model.
I think it is, and I think the view is that infrastructure spend is going to increase, and Halstead floor coverings, are used by and in many schools and hospitals and large institutional establishments on a global basis. I think it's an attractive point of entry.
Staying with hospitals or healthcare, then primary health properties. This is another one There's another real estate company I want to get your thoughts on as well, which I know we've touched on in the past. But this is a company that I think in a lower interest rate environment did incredibly well as a very, very low risk yield play. The valuation dropped quite heavily a couple of years ago, and it's still, I think, languishing quite below net asset value, but yielding close to 8%, and it's been relatively stable in terms of its share price over the last couple of years. So I suppose that counts as a modest win. Are you looking for momentum here? Is there a sense that there can be growth, or is it just a steady lower risk income stream?
There's been a little bit of indigestion recently, of course, and a little bit of uncertainty because of the takeover of Assura, who are, I think the second largest to them in the sector of building new and modernizing medical practices and adding pharmacies and that type of thing. I think it's I've always thought a wonderful widows and orphans stock, with the rent being paid indirectly by government, and I just think it's a very good, solid business, as you say it now, at a discount to asset value. I think the only debit on the horizon has been the suggestion that in the coming budget there might be some extra tax in some form levied on property rental. And I think that has just been a little bit of a dampener on them. And then, of course, there has been the uncertainty over the takeover or the merger with Assura. So I think the market's been a little bit unsure. But I think they're an outstanding buy for income, and they yield around 8% now. And I think one should hopefully see a growing dividend. There surely will be rationalisation benefits from bringing these two big portfolios together.
Another fairly recent stake in the real estate world is Workspace, the London-based flexible office landlord. They're clearly moving with the times and trying to adapt to the way, in particular, small and medium enterprises now approach real estate, which is both cautious and on very flexible terms. It seems like they've also been struggling a little to make all of this work because rent roll, I think, declined in the third quarter. Asset values fell a bit. They're struggling to push through rent rises. Seems like quite a fickle market. What's your reading of where things are all heading for Workspace?
Well, as you say, I think there's been a little bit of uncertainty in the share price, and there has been a slight drift in the in the percentage of properties that are let and the rent roll. But on the plus side, of course, they're staying at a very considerable discount to net asset value. I think the shares are around the £4 mark, and the asset value is getting on for £8. So that's one big plus. Second big plus is the dividend yield, which is around 7%, and the third big plus is that there is an individual investor who I think has got 28 or 29%. Implying that something may happen on the corporate front.
Right.
And fourthly, there is a new chief executive there who's been talking quite optimistically about what he plans to do with the group and bring about some changes there. So I think adding all those four together makes a pretty compelling case once again for putting Workspace into one's ISA and getting that yield and hopefully capital growth as well.
Okay, I'm very conscious we're darting around here, but as ever, there's lots to cover in a portfolio. One company where there's the potential for more corporate action is MS International. There's talk of a possible sale of their non-defence business. What do we What do we know about that?
I used to be on the board years ago,
Right.
so I do. I followed the business and was there when it was a lot smaller. 3 divisions: manufacture of forklift blades, canopies for petrol service stations, and then defence. And defence has really come through very, very strongly as the largest revenue and profit division. I think they felt overall that the valuation of the group has been held back. Normally, had it been solely defence, I think they thought they would be quite rightly on a higher valuation, and therefore they announced that they would be happy to dispose of the 2 smaller subsidiaries or divisions if they could get the right price. So far, they've not got the right price for that. Having said that, the shares have pushed forward nicely. I'm showing a nice profit there, and they are global leaders in small caliber naval systems, lead suppliers to the U.S. Navy and our Navy and the German Navy. So it's a global business. Once again, below many people's radar, but a very big family and board shareholding. So, they've really got a substantial vested interest in delivering value. And, I'm happy to be aboard.
We did, on that note, the large family founding shareholding, we had a reader write in recently to express their concern around the remuneration of the executives and how the corporate governance is structured in that. There's a topic our columnist Paul Jackson addressed in his No Free Lunch column a few weeks ago. And as you say, we should point out this is a largely, family controlled company who are though they are on the receiving end of that pay. have you given this side of the company or the corporate governance question much thought?
As I've said, I was on the board many years ago, and I had my disagreements then. It wasn't so much remuneration then as a reluctance to separate the roles of chairman and chief executive. So when you do invest in this sort of company where there is substantial family or board control, you have to do it with your eyes open. And yes, there has been criticism of remuneration levels and ages of directors. But all I would say is that anyone who's been aboard, for the last 3, 4, 5 years has done extremely well in financial terms because of the very substantial rise in the share price. So swings and roundabouts. Overall, I think most shareholders who are there have been very pleased. One can argue and debate about levels of remuneration. Maybe a little bit on the toppy side. I wouldn't disagree with that, but I would take that into account. And overall, I think the pluses outweigh the minuses. I
think Paul pointed out in his column that the executives were buying shares when things were looking slightly less rosy a few years ago at much lower levels. Let's wrap up with a couple of reader questions. Derek has written to ask if you follow life insurance and pensions consolidator Chesnara, which he described as a potential Lord Lee type stock. I think that's based on the fact it's Preston headquartered, has a near 8% dividend yield, expansion potential, they've just agreed to buy HSBC's life business, and of course the fact that they are a life insurance stock, which is a sector you've been a big investor through Phoenix, Aviva, M&G, LNG, as we've discussed. Is this one you looked at? It's a bit subscale.
Yes, I have looked at it, and it's definitely on my watch list.
Okay.
I think it ticks a lot of boxes. I think the view is that the last deal, this purchase of the pension block from HSBC, is a very good one, and I think that transforms the company and transforms its image as well. I think there was some slight doubts about it before, but I think this has really, improved its overall balance and future prospects and image, and it's one I may well add to my portfolio. Once again, an ideal stock for an ISA, with a very solid 8% yield.
Yeah, and I suppose it's a sector where we have seen some takeover activity in the past year. Just Group and PIC, I think, were bought out by larger North American asset management groups. we get this question from time to time, and you have kind of touched on it in this podcast on the percentage weightings of stocks in your portfolio. You said Goodwin is now up there in the top 3 with
concurrent and M&G
and concurrent technologies. Can you give a sense of the share of those top 3? How concentrated is your portfolio in those just 3 stocks?
Yes, I'd probably need to work it out, but probably the 3 big ones, may well represent, something like. The way things have gone, maybe 50% of the ISA now, with the way they have travelled.
Yeah,
but they're all great companies, I think, all with big futures. So, I'm not worried. But I have quite a nice spread below the big 3. So, I don't feel that I'm overexposed in any sense. I'm not. I think I'd be much more worried if I was overexposed in American tech stocks, for the sake of argument, than in the concurrents and the Goodwins, and certainly not the M&G.
Yeah, very interesting. One just final one. This isn't from a reader; it's from me. I was thinking about in your career. You will have invested in almost every sector, so you will have. You'll have had
every sector. Sometimes I think that I've owned every company, every company at some stage.
And we talked about Halstead, for example. You as a company you were very familiar with at one point, and now you've kind of come back to. At the same time, I'd imagine over a long investing career, you will have some sources of some great memories, some triumphs, but also some scars. How do you sort of reappraise a sector or a company afresh with the sort of lingering sense of what's happened in the past?
Well, I suppose I'm fortunate, really, in that having been investing for how many years now, probably getting on for 70 years, I suppose, really 65 plus. One has a pretty comprehensive knowledge of all the old established or long established companies, and so I pretty well know their history. Many I've been aboard, many I've made money from, some I've lost money on, obviously, but one does obviously build up a huge sort of data bank of knowledge on particular companies, and a share like Halstead's, I know has always been a very solid performer. I have to say, I never thought that it would experience the growth that it did, but it was always cash rich. And I know 1 or 2 friends of mine who stayed aboard and been invested over the years have done very well indeed. There is a big data bank, a big database of traditional companies. It's much more difficult for an individual like me to be aware of all the new AIM stocks and some of the newer ones that come along. I'm not. I'm aware of some of them, but I'm not privy to some of the presentations and some of the early stage offerings via IPO, and so my knowledge of some of the newer ones on the AIM market is less, although obviously some of my very successful holdings have been in AIM shares like Ampario and Concurrent. All the time one is adding to one's knowledge and also hopefully even improving one's technique and honing one's technique and endeavoring to move one's overall ISA portfolio and non-ISA portfolio forward, and thankfully over the last few months, things have been quite good for me. So I've been quite fortunate.
For our final section, I just wanted to very briefly turn to the budget because this is clearly becoming a bit of a theme. The government has, some very big challenges and arguably lacks alignment with any key interest group in the business or investing world, whether it be property ownership, retail investors, or finance. And then hence we've got this intense speculation, which we did last year, about what's going to happen. I wanted to just sort of start with your thoughts on the overall fiscal outlook and just to get the sense of whether you feel that the challenge facing Rachel Reeves is overdone or underdone. There's, the phrase black hole has been bandied around for months and months now, and it's obviously a very, very gloomy tone. Where do you sort of see the challenge facing her?
I think it's a big challenge. I don't think there's any doubt about that. I mean, you can argue about, the OBR and the forecast, as it were. No one can be absolutely sure. But I mean, the fundamental position is we have built up a level of welfare spend. And by welfare, I'm talking very broad brush, including, the pensions, disability benefits, National Health Service, those sectors together, and the overall cost to the nation of all that has clearly been in excess of the productive record of the country, and therefore we've borrowed. Borrowings are clearly too high, and I think she's got a real problem, because I think she would obviously like to bring down elements of welfare expenditure. But of course, as we've seen, she's got, the Labour Party their government have got their own, backbenchers to carry with them, and they've blocked the ability to do much on that front. And then, of course, she gave these, or the Labour Party gave these commitments pre the election, that they wouldn't increase VAT or the standard rate of tax and similar. So they've got that. So we've had this kite flying in so many areas that frankly has been demoralising, and the end of speculation has done no good at all. I think this has gone on for far too long. I don't know why they chose this November the 26th date for the budget. It could have been quite a lot earlier. I think all one can say is that all the predictions of areas where taxes are going to be increased or similar, they're all not going to come off, as it were, and be enacted. So I suspect at the end of the day, some sectors are going to be clearly unhappy. I think it looks almost certain now there's going to be an increase in betting tax. I think it looks as though cash ISAs are going to be reduced. You're going to be allowed to put less in as compared with equities, and I think I'm broadly supportive of that. So I, those with broad shoulders, yes, there may well be some one-off tax on the sale of main properties above a certain figure. I have to say, that I wouldn't be over concerned with that, because I think the vendors, particularly those who've held their houses for many years, will have done pretty well anyway. So if one has to pay 1 or 2% of the proceeds, it wouldn't be the end of the world. So we'll have to see. But I think the biggest concern is the failure of the nation to actually increase productivity. And I can't see that for the majority of people in the country, the standard of living is going to improve. Although people I think expect there to be an annual improvement. I can't see that's going to actually come about. We have too many people clearly who, for whatever reason, aren't involved in the productive economy. So the outlook is not over encouraging. Having said that, we shouldn't downplay the number of very solid, well-established, profitable firms we have in this country, and many are still on pretty modest valuations. So from an investing point of view, I still retain my optimism in investing in UK equities, which is what I've done. In short, there might be some changes to the retail investing outlook, or the sort of the infrastructure, but the underlying health of the options for investors, you don't think this changes? It's not caused me to change my overall approach of sort of selective investment in UK small caps, or occasionally to invest in some of the larger caps. I think there are great opportunities here, and we have new great companies emerging all the time. It's a question of trying to spot them. But the economy isn't in a particularly healthy position, and of course, wasn't helped by the government last time increasing the last budget, increasing national insurance on employers. That hardly goes hand in hand with so-called growth agenda.
Well, fortunately, at least we won't have to speculate too much after the 26th of November because we'll know. I should add that we will be hosting live coverage of the budget and all it means for your money, investments and personal finances on the 26th of November. John, I'm hoping we can speak again here not long after that. It's been a pleasure to speak with you as ever and get the very long rundown on what you've been up to of late in your portfolio. If you have any questions for John, do please message me at the usual email address, alex.newman@ft.com. Other than that, all that's left for me to do is to thank you for listening. Thank you, John, for your time.
My pleasure.
And especially thank our long-term producer, Maddie Apthorpe, who is hanging up the headphones and leaving the mixing desk at the end of November. Maddie, thanks for making the podcast happen. Until next time, goodbye.